Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent move lower since mid-August has been mainly captured with a bear channel, currently 1150 to 1244. However, the influence of the, well, let's be frank here, optimized February to October head and shoulders top neckline, currently at 1254, has had a tempering effect on the move lower, even though the neckline itself is bearish as well. It is just that the neckline is of a shallower bearish angle than the original bear channel, and that is what is tempering the move lower. Hence, I had drawn a newer bear channel, currently 1175 to 1272. Even this newer mid-September base bear channel is, in my eyes, still lacking in confidence, as the optimized neckline is still yet shallower. Nevertheless, I am not letting go of the former more steeply angled bear channel in indicating the direction and size plus angle of the move down, at least not just yet. To add more to the mix, we now have the declining short medium moving average, currently at 1269, entering the frame from above, for all the bearish pressures this brings. All this is happening just at or under the neckline and original upper channel line of the original bear channel. Anyway, 3 weeks ago we reached target X1 on the downside at about 1201. This is, or was, the secondary target for the mid-June, mid-August ascending triangle pattern. In many ways, if you just looked at that pattern, then you could say that the move lower was done. However, we still have target X2 a little lower down. This is the target for the second related pattern. This is the really messy looking bearish halfway hesitation from early to mid-June. This period made the left flagpole, and then afterwards, well, it just became a real mess. I suspect this mess was in part, probably a large part, due to the clash with the previously mentioned ascending triangle pattern. Anyway, I was minded last week to remove this target completely, and I've decided to retire it completely after this week's commentary. That will leave us with targets X3 and X4 below. Wait, what did I just say? Well, you can see target X3, but what about target X4? Well, target X3 in the 1083 area is the primary target for the previously mentioned optimized February to October head and shoulders top. Meanwhile, target X4 is absent from the daily chart because it is the secondary target for the same head and shoulders top, and it's down below in the 904 area. Now, before you start going off, I know that these two are big, huge asks, yet I would rather point them out now than stay silent. That is what the situation looks like right now. Chicago soybean meal. I wrote some 16 weeks ago now, and I've repeated it ever since, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. What I wanted to emphasize back then and every time since, including today, is that everything since May has been in the shadow of that singularly bearish pattern. With this in mind, it brings into perspective the breakdown in June through the long moving average, currently at 379 even, and the further drop down to the lower time, currently 274.10, of the bearish 2021 Andrews Pitchfork. The subsequent bounce up in early July only ended in the market going sideways through July and August, and also running along the underside of the middle time, currently at 320.40. Now, as part of this whole bearish action, the market's moves also created a lower trend line, currently at 344.10. Thus managing to draw a descending triangle pattern over the July and August period. In late August, prices punched down through the lower trend line of this ascending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag seen during May and June. However, when prices dropped down there some 9 weeks ago, the market must have felt it was also too far away from the comfort and security of that same middle time, hence prices moved back up towards it. This is something I'd like you to remember, as it will be coming up again. Anyway, Thursday 5 weeks ago, the market felt secure enough to plunge lower again and punch down through all of the following: the middle time, the old target X, the low of early September at 332.5, and made new lows and low closes not seen since September last year. On Monday 4 weeks ago, prices finally reached down to target X1. This is the initial target for the previously mentioned descending triangle in the 326.10 area. Then 3 weeks ago, the market made a new recent low and grazed the area around the secondary target X2 in the 306.80 area. Now, I have in the past pointed out the caveat, and I do so now again, that secondary targets are far harder to achieve than the initial ones. Anyway, since then the market craved security once again and moved up to fondle the middle time once more. Indeed, the pullback over the last 3 weeks has seen the market exceed the middle time and now tackle the first significant overhead resistance. And that's the dynamic declining short medium moving average, currently at 333.40. That has also partnered with the middle time since about the start of the year. This partnership should not be underestimated, as they have been mutually supportive. Hence, it doesn't surprise me today to see a pullback lower towards the short medium moving average. This does not mean that the pullback up is finished. No. It just means that don't underestimate the power of the various overhead resistances that are above the market up to at least the upper time, currently 366.70. One final point I would like to once again recognize the wonderful job the bearish Andrews pitchfork for 2021, originally drawn back in May, has done in its task of channeling the market lower. It has been useful and valid until this very day, and still seems likely to be so. This bearish Andrews pitchfork is the key to the market here. When it finally gets busted or adjusted to a bearish shift pitchfork or some other pattern, only then can we look for new ideas. Until that time, the bearish incentive is still run and ruled in this market by the same simple bearish Andrews pitchfork. Chicago soybean oil. For months now, I've highlighted the rather lopsided diamond pattern seen back in May to July. Looking again today, I still find it being a very influential pattern, though with other smaller, in most cases competing patterns. A few words again on this diamond pattern. Now, diamond patterns can be tops, bottoms, or continuations. In this particular case, it is, or rather was, a topping pattern. Back in July, the market broke down through the lower trend line, but did not immediately follow through lower. Prices finally dropped in late July and early August, halted for a while by the medium moving average, currently at 60.74. By the middle of August, prices overcame this obstacle and continued their journey lower through the congestion zone between 57.64 to 59.44, which you can see as a striped band across the middle of the daily chart, and punching down through the lower trend line, currently at 50.64 of the July to date descending wedge pattern. The market tried exploiting this breach, but all that was managed was an additional, if short, bear channel over mid-August to late September. 6 weeks ago, the market met a fresh pair of obstacles below which couldn't be overcome. They were the rising long moving average, currently 58 even, and a 50% Fibonacci line for the whole of 2021 so far of 55.43. Nevertheless, the market still tried hard to overcome these, but with no closes below the long moving average, the market in disappointment moved back up again, through the new small bear channel, then the descending wedge pattern, and gaining momentum moved up over the previously mentioned congestion zone between 57.64 and 59.44. In this last process, the market punched this time up and out of the descending wedge pattern, as well as over the flatlining short medium moving average, currently 59.32, and over the slowly declining medium moving average, currently 60.74. However, the move up over the medium moving average has not been easy. 3 weeks ago, prices peaked over the medium moving average with a pipe top before heading back down again, such that today we're seeing the market challenge the short medium moving average, but from the upside. Now, going back for a moment to the original descending wedge pattern from July to September, I had placed a potential target X2 in the 66.80 area for this pattern's move. Now I knew when I placed it, and again today, that this was and is a big ask, and I did point out repeatedly that unless this move up was a false break higher, then this is what the potential target would be topside. I also gave two targets below in the past, initial target X in the 55.90 area and a secondary target X1 in the 53.80 area. These were the targets for the original diamond top pattern back in May to July. Now target X has already been achieved, and target X1, the always harder secondary target, came close enough in mid-September that upon reflection I had decided to retire them both. However, today I've decided to revive them both so that I can have a perspective of this market for both above and below, and maybe to give definition for the future. That is what it looks like right now. A lot of support below and some hard to win opportunity above, if the market is so minded. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.